Hello and welcome to CommBank View Economics and Markets, where we unpack key issues each week with voices from among CommBank's economists and strategists. Hello everyone, thank you so much for joining us today. My name is Mandy Drury and I'm absolutely delighted to be your podcast host. So liquidity is the lifeblood of financial markets. Indeed, the degree to which it is abundant or scarce is really important in terms of implications for asset prices. Financial markets and banking systems can freeze up if liquidity also quickly dissipates. So, if liquidity is so important in terms of making the world go round, we need to unpack it. Why is it important and what exactly is it? Well, let's ask right now my guest in the studio. We are joined by Dr. Hamid Yahyaei, who is Director Fixed Income and Interest Rate Strategy. And thank you so much for joining us today, Hamid. Let's get these basics out of the way. Explain liquidity for us. When economists talk about it, what exactly do they mean?
Well, firstly, it's lovely to be here with you, Mandy. Liquidity is an elusive concept. And in fact, you survey 10 random people, you're going to get 10 different responses. It's, in my opinion, one of the most misunderstood concepts in economics. And broadly, when we think about liquidity, we can break it up into two buckets. We can think about liquidity in the context of market liquidity, which is all about trying to answer the question as to how easily can I buy or sell a particular financial asset. And we typically look at market liquidity through the lens of bid-ask spreads. We look at it through volume measures. Now, that's very important. But what we tend to focus on more broadly, especially in the context of valuations and asset prices in particular, is this idea of monetary liquidity. Now, monetary liquidity is the idea of the broad money supply throughout the entire economy. We're talking about savings, we're talking about credit from banks, we're talking about the actions and role of the central bank. Now, there is a very close relationship between monetary and market liquidity. If you have an abundant liquidity environment, both are going to prosper, and vice versa. But monetary liquidity in particular is what drives what we call the global liquidity cycle.
You know, our listeners might have noticed that here in Australia, despite 3 interest rate hikes, sticky inflation and also now falling housing prices, there's a seeming disconnect, because when you take a look at the stock market, for example, here in Australia and indeed elsewhere in the globe, they're cracking new highs. So this sort of seeming disconnect where we've got bad headlines on one hand, but then you've also got rising asset prices on the other. Can you explain that in the context of how liquidity is contributing to that?
You're right, Mandy, in the sense that there are numerous bad headlines daily. Mm-hmm. The geopolitical backdrop, when we talk about the economic reality, and you mentioned the housing market. And yet when we look at asset prices, there is that real disconnect between the price action and what we see throughout time, and certainly what we experience in the real economy. So we think liquidity is key to a lot of this. How it works in essence is effectively, if liquidity is growing in line with the economy, with nominal activity, it's pretty much absorbed right into the real economy. But if you find yourself in an environment where the broad base of money supply is growing above and beyond nominal economic activity, you have what we economists call an excess liquidity environment. And that excess liquidity, you can think of it as cash sitting on the sidelines in the bank accounts of firms and households. That needs to go somewhere. And one of the natural places in which it ends up is in financial markets. So when you have such a substantial and material weight of money in the system, that will find its way into assets no matter what the headlines are doing. And that's been one of the key trends over, I would say, the past 2 decades.
So when you talk about this money needing a place to go, it needs to find a home, right? Does that also mean that investors in turn are willing to take on more risk and pay more for those asset prices, thus the rising tide lifting all boats?
I'm glad you've mentioned the word risk, because this is very important
Yes.
here. Because what we found, particularly from years and years of research now, is that when there is an excess liquidity situation, when liquidity is quite abundant, investors will typically commit to a series of behavioral biases. They'll commit to what's known as reaching for yield or reaching for returns, which effectively means that all this excess cash, it ends up chasing a finite number of assets. Now, a good example, if you think about it, if you and I are sitting in this room and we've got one asset in the world that we can invest in, but then we invite a colleague to come along, you invite some of your friends to come along. We're all investors in this particular asset, and there's only one asset. So we're all going to start bidding up the price of that asset because we're all sitting on a vast bed of cash to invest. So there is this idea that the more liquidity there is, there's a distortion to the risk signal. There's a distortion to risk aversion as well, which is problematic, particularly if liquidity goes the other way when we find ourselves in a scarce environment.
And indeed, when investors are starting to take on too much risk out there in the market, in terms of keeping the financial market system stable, how do policymakers therefore tweak the liquidity to be able to scale that risk back?
It's a really fine balancing act. Central banks have been trying to do this for centuries. How much money is too much money? How much is not enough? And within the line of research, we typically look at various different parts of the financial market. Things like short-term money markets, which provide us very strong signals to understand if there are pressures arising in terms of funding, to understand if there's a real demand for cash and a scarcity of cash. By all accounts, 2026 has been a year of abundant liquidity, and we haven't seen that pressure come through in any substantial magnitude.
Not all asset classes are created equal, though, are they? So how does liquidity affect asset prices? And is it equal, in your view?
It isn't. It affects asset classes very differently. Typically, what you find in an environment of abundant liquidity is that those close substitutes to cash are the assets that benefit the most from that excess liquidity. So we're thinking about things like fixed income instruments. We're thinking about assets that are typically low risk, in which case a portfolio rebalancing effect happens. Investors will allocate that money into these assets because they're almost like for like in terms of risk. But that's not to say that there isn't a broader impact as well. We find that once that process has gone through, we see effects on corporate bond markets, we see effects on risky assets, and eventually even equities to some extent.
Bringing sort of some of these concepts to life with real-world examples, explain to us what exactly happened during a very unusual period such as COVID.
COVID is the dream scenario to look back and to really appreciate the importance of liquidity. So if we take ourselves back to March 2020, it looked like the world was entering a dark new period, vast uncertainty, financial markets were selling off left, right, and center. The pandemic episode was a clear signal that liquidity matters for asset markets. In particular, we had both sides of the equation. You had central banks creating vast amounts of money into the system through bank reserves. And you also had the government response. So the government committing to vast amounts of fiscal policy. When you combine the monetary and the fiscal policy response, you're enhancing liquidity. So even though it looked like we were in a dire state of the world, asset prices just rebounded and set new highs after new highs. And we've seen similar episodes throughout history. These so-called exogenous shocks, disruptions to markets, be it pandemics or the global financial crisis, when liquidity is abundant, when you have money printing at substantial amounts over and beyond the productive capacity of the economy, that money finds its way into assets.
It's really a classic example of the old adage of the economy is not the market, and bad news for the economy can often be good news for asset prices, right? But give us an example of the reverse, when suddenly that tide of liquidity goes out, when it's reversed.
In environments where you find yourself facing a scarce liquidity environment, we see the inverse happen quite vividly. You see funding spreads rise, risk premia across financial markets rise. You see volatility increase because that scarcity induces a lot of the precipitous declines that we see in assets. In other words, we economists, we call it the manifestation of frictions in the market. And this is simply because assets are finite at any one point in time. The money that is invested into them can change. And if you drain that liquidity out, asset prices are a lot more vulnerable to the bad news. So that's why when we sort of step back and think about the current environment, with so much money on the sidelines, that can really suppress the negative impact of a lot of these bad headlines.
You mentioned before that, for example, with the COVID response, you had this sort of, double bang, bang punch where you had the central banks printing money or providing liquidity, and you also had the government providing liquidity. So when we talk about liquidity and where exactly it comes from, it's so much more than just central banks printing money, isn't it?
Absolutely. Central banks play a very important role. They create what's known as reserves, and in a fractional banking system, those reserves are effectively held at the central bank on behalf of commercial banks. Now, commercial banks are key because the more liquidity in the system in the context of central banking liquidity, the more capability a commercial bank has to actually lend money into the real economy. And Mandy, this is key. The commercial banking system is the amplifier that extends that liquidity to you and I, to households, to firms, to businesses. So without the amplification, you can't have that liquidity disseminated broadly into society. So central banks are very important. They create effectively the base money supply. They create the currency in circulation, but it's the banking system that then takes it from them to us.
And can also the positive benefits of liquidity being provided sometimes be mitigated by the fact that you might have, for example, central banks and governments working at cross purposes. You might have a central bank that is trying to rein in inflation and therefore is hiking interest rates. And then you might have a government that is also, with the fire hose out there providing support to the economy in terms of fiscal support, and therefore they're not able to work in tandem to achieve the desired result.
Absolutely. This is a classic dilemma that we call the monetary-fiscal nexus, the relationship between two very important parts of the broader economy. And if they're not working at purpose on the same sort of wavelength, you have these issues where you're right, you have these offsetting effects where you have a central bank tightening monetary policy, reducing liquidity effectively. Meanwhile, you might have a fiscal response that's contributing to liquidity, certainly at the household level. So it's very important for these two pieces to work together in unison.
Explore where we are in terms of the global liquidity picture right now in 2026. How are we sitting in terms of the liquidity cycle?
So we've done a lot of research to understand across 150 different countries, where do we stand in terms of the global liquidity cycle? And certainly what we see is that 2026 thus far has been a modestly abundant liquidity environment. And we think this is contributing to the broad demand for asset prices. It's suppressing or offsetting some of the bad news. It's not all widespread. Some financial markets have been very sensitive to the bad news than others. Things like sovereign bond markets have obviously faced a very tough time with rising bond yields in unison with higher oil prices. But certainly other parts of the financial market have really benefited from the liquidity. So by our account, we think liquidity is abundant. We think it is a supportive backdrop for financial assets. And there doesn't look like to be any change on the horizon for the rest of the year thus far.
Even in Australia, we've had these interest rate hikes. Do you feel that liquidity is still abundant in Australia?
The reason we call it the global liquidity cycle is because it travels all around the world, and this is key. The fact that liquidity is abundant or scarce in a particular country is less important than the overall system. Because of the global mobility of capital, the ability for $1 to go from one country to another almost instantaneously, that global capital will find its way into markets like Australia.
Hamid, what kind of amber flashing warning signals would you say would give you the indication that this liquidity or this abundance of liquidity, over the 150 countries that you've been analysing, is starting to turn?
So we spend a lot of time looking, as I alluded to, these short-term money markets. You can think of them like the plumbing of the financial system. No one really cares about it until there's a problem. So we spend a lot of time looking at very short-term funding spreads. Any time that we identify that these spreads are getting very, very pressured, or there's a scarcity or a demand for cash, these are the early warning signals that perhaps liquidity is starting to drain too quickly.
Are there sometimes, though, some false warning signals? Because remember, we had a bit of a scare in the private credit sector, and then, and people were starting to wring their hands and say, oh, this is a warning sign for the rest of the market. And it actually turned out to not quite be the concern that we originally thought it might be.
Most definitely, and this is why we look at the weight of evidence. So it's our work in unison with the work of other independent providers of liquidity measures. We look at different parts of the financial market. And just because you identify scarce liquidity in one pocket, definitely doesn't mean that there's scarce liquidity in other pockets. You might have abundance here and scarcity there. And so what we try to do is try to take a step back and take a look at it from a holistic perspective. If the global liquidity supply is indeed abundant, that should have ramifications down the line.
It certainly begs the question, though, which market or which asset pool would start to show the warning signs first? Would it be credit? Would it be bonds? Would it be equities? Or would it be something else?
Historically, we found it's the bond market. The bond market is certainly king when it comes to giving warnings ahead of time. And sometimes you find that it takes a little while for that effect to flow through to things like risk assets, like equities or corporate bonds. But certainly the bond market is the most sensitive, especially the shorter term parts of the bond market.
What if liquidity starts to fall quickly? And maybe you can give us some examples of when that's happened in the past. Where do we start to see that sort of show up? What cracks do you see first when liquidity is drained rapidly?
In 2013, we had an episode called the taper tantrum, which was the first sort of initial stages, even just initially thinking about reducing the vast amount of liquidity that had been inserted into the real economy in the United States after the global financial crisis. And we call it the tantrum because bond markets threw a tantrum. We saw bond yields rise immediately, funding spreads start to rise, risk premiums start to rise. So you don't even necessarily have to reduce liquidity, but the threat of reducing liquidity often leads to those first initial signals with bond markets repricing very
And then in that sort of situation, I mean, what exactly was the response to be able to calm that tantrum down? And generally, what would be a response that is appropriate for a sharp tantrum like that?
So pre-COVID, we saw examples of when the central bank did enter the market and try to quell that volatility. So they would just come in and effectively undo the drainage that had been accumulating up until that point. And it's a really fine art to try to find where that threshold is. How much is abundant? How much is scarce? And you can only really know once you've tested those waters.
How blunt an instrument is, though, for example, a central bank providing liquidity through, for example, an interest rate cut?
Initially, the provision of liquidity is very effective at restoring market stability and restoring functioning, especially to short-term money markets. The question is, however, longer term, what are you giving up for tomorrow by injecting that liquidity today? Is it leading to a easing in financial conditions that may go against your mandate, or say you're trying to target inflation? Can it be counterproductive? So it's this fine balancing act between making financial markets operate sustainably, making sure they're efficient, versus achieving your mandate, be it inflation or price control.
Can you have a situation whereby liquidity is being drained, but asset prices still go up?
You certainly can. And we've seen that in pockets of, say, the equity market, where in those particular parts of the financial market, it's the thematics that matter. We're talking about earnings, and certainly the artificial intelligence topic, which has been talked about many times. These thematics can outweigh the scarcity of liquidity. That's why the impacts are felt most predominantly in bond markets.
So it's momentum that takes over in that situation, isn't it?
Certainly the momentum can just get ahead of itself, and bad news or scarce liquidity is put to the side because these thematics just keep driving the market higher.
I'm sure that a lot of our viewers and listeners are, very savvy investors, and they might be themselves, completely on top of this topic. But for those who, for example, may not be, what do you think is a key takeaway here? If you're not watching the headlines every day, if you're not, watching the markets every day, what's a takeaway that we need to think about when we talk about liquidity?
There are forces at play that are very hard to observe, very hard to measure. Liquidity, of course, being one of them. And when you look into the various different measures of liquidity, and they're all pointing towards the one way, that liquidity is abundant, it is clear to us that this has a very beneficial impact for asset prices. And as a global backdrop, it's one of the key reasons that we've seen asset prices rise and suppress a lot of the bad news. So for everyday investors that are sitting there thinking about how does liquidity impact my assets, next time you see a really bad headline and yet the market continues to rise, ask yourself, what's going on here? What's this disconnect doing? Is it a function?
What's going on beneath the surface of the financial markets?
But beneath the surface, the plumbing of the financial system, is liquidity so abundant that a lot of this bad news, simply in the short term, is being disregarded.
So Hamid, what's your prediction for liquidity levels going into 2027? Because as you mentioned, in 2026, when you look at the 150 markets, on average, there's abundant liquidity, and that has certainly shown up in how asset prices have reacted this year. But what about next year? Will it remain abundant?
Hard to say at this point, Mandy, only because liquidity is a function of the decisions of central banks and the commercial banking system. So it is highly contingent on where we find ourselves in 2027. But thus far, in terms of the research that we've done on a forward-looking basis, at least for 2026, things are abundant. 2027 is really at the whim of how central banks react to the broader backdrop. If we find ourselves in an environment of still persistent inflation and there's a need to reduce liquidity in order to maintain control over prices, well, then we might find ourselves in a potentially scarce liquidity environment. But thus far, as we sit here today, the backdrop is very supportive.
So bottom line it for us, Hamid, because I personally have learned quite a lot about the plumbing and mechanics of liquidity. What's the key takeaway that our viewers and listeners should take from this?
Liquidity is the lifeblood of financial markets. It is a very important component to asset prices, for risk premia, for volatility, really for the entire backdrop. And even though it's an elusive concept, it's difficult to measure, it is nonetheless having a real impact on the here and now on financial markets. And it's very important to be aware, particularly of those changing points in the global liquidity cycle.
Excellent. Thank you so much for joining us today, Hamid.
It's a pleasure.
Before we let you go, let's take a look at the week ahead in the markets with John O, who is Energy and Sustainable Economist at CommBank. John, welcome back to the studio.
Hey, Mandy. It's always good to be back.
Fantastic. Well, let's take a look, first of all, what's happening here at home domestically. Out of Australia, we've got wages coming up, don't we?
Yeah, that's right. On Wednesday, we have the wage price index coming out for the quarter 2 of this year. We expect it to come out at 0.8% for a quarter, and it means in annual terms, it drops from 3.3% to 3.2%. And this aligns with the slack that we're seeing in the labour market, which we expect to be stable at this time currently.
And dovetailing into that, we're also going to get a reading on the labour market itself, aren't we, John?
That's right. On Thursday, we have the labour force survey out for July. So we do expect employment to be flat. We expect participation rate to have dropped a little to 66.9%. And overall, that means that unemployment rate, we think, will have not changed and be at 4.4%. So our internal data does show that there is no sign of material re-acceleration. Survey measures of employment intention point to softer conditions as well. So that's why, broadly speaking, we do think that the slower economic growth will lead to an increase in unemployment rate, and we see it peaking at around 4.7%, but in late 2027.
Let's move offshore. What are we expecting in terms of inflation numbers out of the UK?
So first up, we have UK CPI. So we do expect the headline inflation likely to have increased and on annual terms to 2.9%. And that's because we have seen energy prices increase across Europe. And as a result of that, they lifted the household energy price cap. And so that's why we see we have expectations that inflation would rise. However, for the Bank of England, we do think they'll look through this inflation because there is weakness in the labour market that we expect to see even this week as well. And so that link from high inflation to higher wages is likely to be limited.
And what about a country that battled deflation for many, many, many years and now, of course, has inflation? Japan.
That's right. So on Friday, we have the Japanese CPI. We expect the inflation to increase on annual terms to 2.1% for the year. And we've already seen the Tokyo CPI already come out, and that gives a good steer on what we expect for the national CPI. And as a result of that, the numbers suggest that headline and trimmed and core inflation would have increased in July. And that shapes our view for the BOJ. We currently do think that they will hike in December, but there are risks that it might happen earlier as well.
And last but not least, the FOMC, Federal Reserve. We've got the minutes coming out.
Yeah, the markets will be keeping a close watch for how close the committee was to hiking in July, given 3 members dissented. So that'll be a key thing to watch. But also the markets will be watching on the Fed Chair, Kevin Warsh, what his thinking is, because so far we haven't learned particularly a lot. And so every minute meeting that comes out, it gives us a good perspective on what he's thinking and where he's at.
We're hanging on every word. Thank you so much for joining us today with the week ahead, John O.
Thanks, Mandy.
And thank you for joining us today for this edition of CommBank View. Please do join us every single week. And I'm Mandy Drury, your podcast host. Thanks for joining us.